Hi, everybody. Luke Gromen, FFTT. Hope you are well, having a great week. I am going to jump right in. Thanks, as always, for submitting the questions. Really enjoy these back and forths and the thought process it generates. So I'm going to jump right in. The first question is from Jerry. Do you think the gold/silver bull run is done after the price collapse this week, or do you advise to hold on to gold and gold miners? I appreciate it's difficult to call a top in the market, but what are your thoughts on it when we might be time for us to go back into fiat? Thank you. For me, determining whether gold has topped is primarily a function of just two questions. Number one, is the U.S. willing to let China make more and more of its weapons for us and eventually make all of the weapons for the U.S. military? Question number two, will China and Russia elect or otherwise institute Yeltsin-like leaders who are willing to sell off their country's assets to American interests for pennies on the dollar and then turn their nations into full-on U.S. economic vassals willing to buy infinite amounts of treasuries with surpluses at negative real rates and thereby allowing the U.S. to expropriate the wealth of those countries fully in order to support Washington largesse and U.S. defense payments and U.S. entitlements payments? If the answer to either of those questions is no, then the top in gold is not in. That's how I'm thinking about it with my own money. From CT, expound upon the notion that if they can't raise rates to 15% to protect the dollar, then gold will rise to $20,000 to protect the dollar. What other paths are possible? Or is it really that binary? That's something I wrote in conversation with an acquaintance on X yesterday. The notion is that once you need negative real rates just to keep the debt nominally sustainable, nominally solvent, which is where the U.S. is, you can either get a productivity miracle that arrives just in the right amount of time, you can get austerity, 15% rates, or you can devalue the debt, $20,000 gold, delever debt to GDP to make it easier to grow out of from that point. Those are your options. That's it. From MM, the impact of foreign countries like India proposing to allow citizens to tokenize their own gold, silver, and real estate to bring it on-chain and convertible into spending deposits into their economies. I don't know. That's a good question. I would think that in emerging market countries that have historically had high levels of gold and silver ownership, places like India, but that have had low, what I would call velocity of that ownership, low financialization of that ownership. I would think something like that, making it more easily spendable, would increase the velocity of those monetary assets, which would all else equal be good for consumption, also inflationary. And obviously, that's something we're trying to drive more of in terms of India and China, more consumption to try to rebalance things. So that's my first blush thought at it, but I'm not sure. So I'm going to have to think about that more. From VV, what are the odds that as the increase in AI reduces employment, the government stops the progress of AI? You mentioned that AI does not work in a debt-laden country. I liked your logic regarding the reaction from the banks. It's not only just that it's debt-laden, but it's also the debt backs the currency. And so if the debt starts to default, the currency has a problem. So I think the odds of the government stopping it are extremely low. China took a lot of jobs from the U.S. From 2001 to 2020. The government didn't stop that at all. Furthermore, China's not stopping with their AI progress now. And so as long as China's not stopping it, the U.S. isn't going to stop it either, or else they cede the field to China. So I think the odds of the U.S. government stepping in proactively, which I don't know that they ever do anything proactively, which is probably our answer right there. But the odds of the U.S. government doing something proactively to stop AI because of the risk of job losses, I think, is extremely unlikely. From RN, what is driving the gold to oil ratio to climb this high? Over time, do you expect it to snap back like it did in the early 70s? How do you reconcile this with shale being the swing producer over the last 10 years and that production is now rolling over? In my opinion, the reason the gold to oil ratio is at near all-time highs is multi-currency oil pricing. Oil is now being priced on the margin in yuan, other currencies. The sanctions on U.S. Treasury markets that the U.S. implemented in 2022 vis-a-vis Russia, U.S. reshoring of the industrial base, even discussions of this means that the world needs to move to a new reserve asset away from treasuries. The only asset that fits the bill is gold. And that is that means that as there is a push towards a neutral reserve asset from all of these initiatives, that means that gold is the new reserve asset. That means gold is the new oil currency, replacing the dollar as the primary oil currency, oil reserve asset, more accurately. And the reality is that the oil market in physical terms is 8 to 10 times bigger than the gold market in annual physical production terms. So you try to fit 8 to 10 pounds of oil into a 1 pound bag of gold. Bag of gold expands, gold to oil ratio goes up. I think it's going to keep going up over time. Doesn't mean we're not going to pull backs as we're seeing the last day or two. But ultimately, I think it goes quite a bit higher. And ultimately, if shale production rolls over, I think you'll see the gold to oil ratio rise even faster. Because ultimately, that would probably be good for oil prices on the margin. But ultimately, oil prices over $85 a barrel have broken the treasury market. We've seen that over and over and over. You start to see rates rise too rapidly, treasury market dysfunction, and then some sort of liquidity gets injected. And ultimately, to me, that means gold's got to rise relative to oil secularly to much higher levels. I think it's going over 100 barrels an ounce over time to start. From hey Luke, Michael Howell thinks that next year Treasury will funnel money, directly into the real economy, not into financial markets for national strategic reasons. What's your opinion here? How does that mechanically work if he's right? I agree with that. I think that's what's going to happen. I think it's already kind of starting. U.S. government funds investments into various projects, buys equity stakes in different companies. You probably are funding some of that through DOD. Probably paired with the private sector, as we're seeing. In my opinion, you still need to keep long-term treasury yields capped. Presumably, we kind of get more of what we've been getting, which is shifting to the short end by treasury buybacks. And I think the hope is that stable coins with backed by T-bills can help that. And so to me, when I kind of take a step back and try to see the big picture of what they're doing, they seem to be trying to do a more modest version of the reindustrialization that they did during World War II. But they're trying to do it without explicit yield curve control, without capital controls, without rationing consumer spending, without having to take the marginal tax rate at the highest bracket to 90% like they did in World War II, which would create a whole bunch of other problems as well. Let's see if they can do it without the yield curve control part. Some of that, I think, depends on events, as we saw here today. Look, if the Trump administration wants oil to go up because they're sanctioning Russian oil and trying to do it out of the market, we get an oil spike, you're going to get a 10-year yield spike. And the 10-year yield spike is going to go to levels that trigger all kinds of problems for stocks, the global economy, etc. And then the government's going to have to figure out if they want to inject more liquidity to control yields, or if they want to let things go into a debt spiral for the U.S. and for the West and the world more broadly. And then the final question, Mike, full report subscriber here. Thank you very much, Mike. Appreciate you. Can you talk about different ways to own gold? Do you consider GLD or IAU appropriate, or do you prefer PHYS? Are you advocating you keep actual physical gold in a safety deposit box? So for me, GLD, IAU are appropriate for short-term trading. I think if you have to own an ETF, I know the sponsors of PHYS, met with them before. That's, I think, a good option. I prefer, if I wanted, I prefer bullion in a safety deposit box, even in a bank safety deposit box if you have to. And out of the banking system, safety deposit boxes are better, in my opinion, if you have some in your city, town, or locality. Look, this this is not a question of does GLD or IAU or PHYS have the gold. That, in my opinion, they absolutely do. I have no doubt about that. What I have doubt about is that Western social democracies, they're not exactly covering themselves in glory vis-a-vis their maintenance of individual property rights and the rule of law, vis-a-vis their own citizens, and certainly vis-a-vis the citizens of other countries. So, um, like I said, I've got no doubt that these vehicles have the gold they say they do. What I don't trust is that in a pinch, the countries in which they're domiciled wouldn't get handsy with centrally located bullion. So I want to be clear. I don't think that's a high risk, but I also want to be clear that investors need to be aware that that is a tail risk. It is a fattening tail risk, and it's a risk all investors need to consider vis-a-vis their gold exposures. For me, I would rather just own gold bullion coins and take all of the mystery out of it. So with that, I'm going to finish up for today. As always, thank you for joining me. If you like these updates, check out FFTT-LLC.com for more information about our Tree Rings product. This week, we are running a special through October 26th, ending at midnight, or technically 11:59 Eastern Time. You get some bonuses. You get 4 free weeks and some other bonuses if you sign up for Tree Rings by then. So check it out, FFTT-LLC.com. Otherwise, have a great rest of your week. We'll talk with you soon. Take care.